We're diving into electric vehicle stock comparisons, where we'll be pitting the most popular EV stocks against each other in a head-to-head grudge match to determine the best investments you can make. We're starting with the startup EV stocks, Lucid Group and Rivian Automotive, then NIO versus Tesla. Who among these companies will rise out to be the best? It's a surprising outcome, so make sure to watch till the end. When analyzing these stocks, we'll be looking at two things. Firstly, the most recent quarterly earnings, where both companies reported a challenging quarter for EV stocks. But it's not just about the numbers. I'm also interested in how each company manages the current environment and its common problems. I want to invest in companies that are dealing with these challenges effectively. Secondly, I'll look for any longer-term strengths in each company which could give them a competitive advantage and drive those longer-term profits. So let's buckle up and get into our EV stocks list. Let's start with Rivian, who reported producing just over 10,000 vehicles last quarter and 24,300 for the year. Although that brought in revenue of $663 million, it missed expectations of $717 million. However, the company did beat on its earnings, narrowing the loss per share to $1.73 versus the estimated $1.91. Despite these positive notes, the stock plunged 18% due to two factors affecting the entire EV group. Firstly, Rivian faces supply chain issues and noted multiple days of lost production because of supplier shortages throughout the quarter. It expects these supplier issues to continue this year and updated its production forecast to 50,000 vehicles, double last year's production but well short of the previous estimates for 63,000. Secondly, the cost of production jumped 280% in the fourth quarter from the previous year to $1.7 billion. So although its revenue grew 12-fold, the cost of goods sold was over $1 billion more than that. As a result, the company burned through over $6.4 billion in cash flow last year, despite having around $12 billion in balance sheet cash. This means it will likely need to raise funds next year and dilute shareholders more. On the upside, Rivian announced that its Max Pack battery variant would be available for pickup and SUV models by fall this year, increasing the range by around 50 miles each. Moving on to the Lucid Group, ticker LCID, the company's loss narrowed to $2.56 billion on revenue, which jumped 22-fold to $608 million. It reported production of 7,030 vehicles last year and guided to nearly double that with 14,000 this year. However, just like Rivian, it missed expectations for 21,000, with Lucid also blaming parts constraints and a weakening economy. Despite this, Lucid was only down about 6% on this report. But there is a concern. The company reported 28,000 reservations in late February, down from 34,000 at the end of September. With only 2,000 vehicles delivered, another 4,000 customers canceled their orders. Lucid's EVs start around $87,000, with some well above $100,000. So recent price competition from Tesla and Ford could hurt sales. Lucid did announce a limited-time $7,500 discount on some models, but it may need to be cut further later. On the cost side, the cost of goods sold for Lucid climbed 307% to $615 million during the quarter, well above the $257 million in sales it booked. Like Rivian, the cost to produce these EVs exceeds their sale prices. Additionally, the operating expenses add up to a considerable amount, making it crucial for the companies to show significant growth to achieve profitability. Furthermore, the balance sheet cash has reduced to $1.74 billion, and more funding will likely be needed next year. As these newer EV companies are developing batteries and production processes, their capital expenses are enormous. This makes it difficult for them to target any other market apart from the high-end luxury market. With the production cost estimates for each vehicle shown by Morgan Stanley, it's clear that even with their luxury prices, both Lucid and Rivian are losing a lot of money on each car they sell. In contrast, Tesla's reached a point where it can sell to the middle-income market. Selling 100,000 electric vehicles may have worked in 2021, but not in a weaker economy and with a price-conscious consumer. Last year, higher interest rates result in an affordability issue through price cuts and competition. However, with a weakening economy, this strategy is no longer sustainable. Interestingly, Rivian's shares are valued much lower than Lucid's, despite being less than half as expensive. Rivian is also much further along in production development, with an estimated 50,000 vehicles produced this year compared to Lucid's 14,000. Rivian's higher production level will allow them to optimize costs and increase profitability in the future. On the other hand, Lucid is likely to struggle with cash burn. Therefore, the choice is clear, and Rivian is the better option. We still have two more EV stocks to watch: Tesla versus NIO, but a perfect portfolio should include both cash flow and growth stocks like these. Before we move on to the more established companies, I'd like to thank and congratulate you for reaching halfway through the video. What do you think of Rivian and Lucid stocks? Who among them is better for you? Let me know in the comments. We'll talk about NIO and Tesla stocks in a few minutes, so sit back and relax. And don't forget to hit the like button and subscribe for more content like this. Now, let's examine two established EV companies, NIO Incorporated and Tesla. NIO reported impressive Q4 numbers, with deliveries up 60% to over 40,000 vehicles and revenue up 62% to $2.3 billion. For Q1, the company expects revenue as high as $1.65 billion and 33,000 deliveries, a 28% increase from last year. NIO still targets the premium market segment in China, with a retail price starting at $46,500, but plans to launch a mass market brand in 2024. One unique feature of NIO is its battery as a service model, which allows customers to swap out their batteries to supplement charging and lower purchase prices by up to 30%. The company aims to have 3,000 swap stations in China by 2025 and another 1,000 outside the country. China has been a pioneer in EV technology and is expected to have 30% of its 2025 car sales as EVs, versus just 10% in the US. Tesla has a strong presence in China, but remains at risk as an American company versus domestic favorites like NIO. However, like other EV startups, NIO has seen inflation and cost pressures, dropping its gross margin from 17% to just 3.9% in Q4. Nonetheless, the cost increase represents an 87% increase in their production costs, which is much better control than we saw with Lucid or Rivian. In terms of Tesla, the company reported its best earnings report of the quarter, with shares up 11% on the day. Tesla's revenue of $24.3 billion was up 37% from the year before, and its gross margin of 24% is high compared to its competitors. Tesla's competitive advantage is twofold. Its size gives it power over suppliers for lower prices and preferential delivery. In addition, the company has worked through growing pains seen by other car makers. Tesla is projecting production of 1.8 million vehicles by 2023 and has other revenue drivers like the Megapack and developments in self-driving, solar, and an autonomous taxi service. In terms of valuation, while NIO is growing sales at 62% per year and producing over 120,000 cars, it's trading at a steep discount to Tesla, which is more profitable but trades at over 3 times as expensive. While there are geopolitical risks with NIO, it's close to that tipping point where the production scale gets costs down quickly, leading to stronger profitability. Despite this, the preference is for Tesla due to its grander scale and margins and its ability to compete on price, and likely take market share over the next year as customers become more price conscious. In terms of leverage for profit, Tesla is currently more advanced than NIO, as it has already developed its self-driving and autonomous taxi features. While NIO is also working on these projects, it could be further. Tesla's advantage over other EV startups is its ability to focus on multiple projects due to its size and economies of scale. Although there is potential for growth in NIO, there's also a risk associated with investing in a Chinese company due to geopolitical issues. While Lucid is the weakest of the group, Rivian is further along in production and has a better valuation. Overall, Tesla is the leader in EV stocks, although it's more expensive after doubling in price this year. So, while NIO has potential, Tesla is the go-to for investors looking for a stable investment in the EV market. What do you think? Who among these four deserves a spot in your to invest on list? Let us know in the comments. And if you enjoyed this video, don't forget to like, share, and subscribe to be notified of the next one. This is Fred, and thank you for sticking with me until the end. See you in the next video. If you're curious as to why Lucid Motors is struggling to attract customers, check it out on this video.